If you're brand new to options trading, one of the confusing things initially is the fact that there are so many option strategies. There's hundreds of option strategies out there, and all of them are different. They work under different conditions, and with so many strategies available to you, sometimes it can be confusing to figure out, hey, which strategy should I choose? So today's topic is the fact that there are so many option strategies. Which should I choose and why? And of course, this will depend on the situation. So there are literally hundreds of option strategies to choose from. There are bullish strategies, bearish strategies, and neutral strategies. Some strategies are credit trades, while others are debit trades. Some strategies have undefined risk. Some have defined risk. Some strategies benefit from volatility expanding. Others benefit from volatility contracting, and still others aren't really affected by volatility all that much. Now, with so many variables to consider, which option strategy is right for which situation? So this next slide is a little chart I put together, and obviously there are hundreds of option strategies, and I just put this table together of some of the more common strategies that most of you are familiar with and probably use on a somewhat regular basis. So this is a few strategies to know, and you can see this chart is broken down by bullish strategies that have undefined risk, bullish strategies that have defined risk, bearish strategies that are undefined risk, bearish strategies that are defined risk, neutral strategies that are undefined risk, and neutral strategies that are defined risk. And depending on whether the underlying asset that you're buying or selling those options on, does it have high IV rank or does it have low IV rank? So let's start with the bullish strategies. That's probably the most common strategy that most of us are putting on, especially the bullish undefined risk strategies. So typically, if anything has high IV rank, so a IVR of 30 or more, my go-to strategy if I want to be bullish in that position is always the short put. I sell a put. And if I'm a little concerned, I want to hedge my bets a little bit, maybe instead of the short put, I'll do a short put ratio spread. So a 2-by-1 put ratio spread where I sell 2 puts but buy 1 put as a hedge. So the short put and the put ratio spread, they're bullish, undefined risk trades. Their risk is to the downside. They have unlimited risk to the downside all the way to 0. And because they benefit from volatility contracting, you want to put these on when IV rank is high. Any short option strategy, so anything you sell, anything that you receive a credit for, typically you want high IV rank. Now, what happens if you have a stock that's got low IV rank, but you want to put on a bullish trade and maybe you would like to do undefined risk? Well, covered calls work pretty good in that situation because covered calls, they involve 100 shares of stock plus a short call against it, right? So the shares are not affected by volatility at all. Implied volatility rank has nothing to do with your stock position. So therefore, a covered call is not a bad plan for something that's got low IVR. You could theoretically also sell short puts in something that has low IV rank, even though we said you'd prefer high IV rank. A short put, even though you're not necessarily going to benefit from a volatility contraction because volatility is already so low if something has low IV rank, but it does have a directional component to it, right? You're bullish, and if you get the move that you're betting on, your short put will still be profitable, even on something with low IV rank. But I would probably, unless it's something you just really want to trade, I'm not usually selling puts on something with low IV rank. Usually I'll go find better things to trade, something with higher IV rank to sell puts on. Now, what about bullish defined risk that has high IV rank? So if you find something that has high IV rank, you want to be bullish in it, but you can't do undefined risk. So you can't do the short put. You can't do the short put ratio spread. What do? Well, the put credit spread. That's your go-to trade. Just learn to love the put credit spread. It's a great strategy. Now, what happens if you want to do bullish defined risk on something that has low IV rank? Well, you could just buy a long call, right? Just buy an at-the-money call. You could also buy an at-the-money call debit spread. You could do a poor man's covered call, which is a call diagonal spread. You could also buy a long call butterfly spread. All of those work just fine in low IV rank. For bearish undefined risk trades, you have the short call and the short call ratio spread, so the opposite of what we did with the short put and the short put ratio spread. So bearish undefined risk, short call, call ratio spread. Now, low IV rank, and we want to do bearish undefined risk. Well, instead of the covered call like we did if we were bullish, if we're bearish and want to do undefined risk, you could do a covered put where you are short 100 shares of stock and you sell a put against it. This is not a trade I typically do, but it's certainly something you could do if you choose to. And kind of like the short put, yeah, you can do it in low IV rank. It's not something I love, but it's certainly possible. You can also sell a call on something that has low IV rank, even though you're not going to benefit from that volatility contraction. Again, just a naked short call does have a directional component, and if you get the direction right that you're betting on, that short call will still be profitable. For bearish defined risk trades with high IV rank, you want to do the call credit spread. That's your go-to strategy. For bearish defined risk with low IV rank, I would just buy a long put. So that's typically buying the at-the-money put, or buying the at-the-money put debit spread, or doing a poor man's covered put, which is a put diagonal spread, or just buying a long put butterfly spread. Moving on to the neutral trades. So neutral undefined risk trades. So for me, this is all about stocks that have good IV rank. So anything that has an IV rank above 30 and I don't have a directional assumption at all, my go-to strategy is the strangle. I sell a lot of strangles on a lot of different products. If you wanted to, you could also do a jade lizard. A jade lizard is essentially a short put plus a call credit spread. So you still have undefined risk on the put side, but the call credit spread, you've defined your risk to the upside. So a jade lizard is a nice alternative to the strangle, especially on an earnings play where maybe you're worried about a particular stock exploding to the upside, but you're not really worried about it to the downside. Something like a jade lizard is a nice alternative to that strangle. Now, what about a neutral undefined risk play in something that has low IV rank? Well, I really can't think of anything, right? So the thing with neutral trades is you want to put those on and benefit from a volatility crush, a volatility contraction. So I'm not trying to put on a strangle or a jade lizard and anything that has low IV rank. It just doesn't work. Because you're betting so heavily on that volatility contraction, you do not want to go put these things on in something that has low IVR. So if I'm looking to sell strangles and stuff, if it's got low IVR, it's not a possibility. I just move on. Now, what about neutral defined risk trades? Well, that's all about the iron condor. So in high IVR, you want to sell an iron condor. And if you have low IVR, this is where you're probably going to do a butterfly spread. So a long put butterfly if you want to play it to the downside, or a long call butterfly if you want to play it a little bit to the upside. Or you could do these neutral. You could put on a butterfly spread that's kind of directionally neutral, similar to an iron condor. And these typically are what you would put on when IV rank is really low, and butterfly spreads especially work on shorter dated trades, where iron condors typically work better on longer dated trades. So let me show you some of this in action. Let me switch over to my trading platform. Of course, I use TASTYTRADE as my trading platform. I'm just going to go to one of these watch lists I have on the side here, and I'm just going to go through some stocks, especially some stocks that I don't have a current position in, but I would show you how I would play these if I wanted to play these. Let's start with DIS, which is Disney. So Disney right now, let me move to the options table here, has an IV rank of 30. A IV rank of 30 is my minimum as far as high IVR. So it's got high IVR. I don't really have a directional assumption in Disney right now. It's at the higher end of its range. So let's imagine I want to be bearish in it. So it's got good IVR. I want to be bearish in it. I'm going to go to the 58-day cycle. And this is where I would either sell a call or I may sell a call ratio spread. Let me do the ratio spread. So I'm going to buy a call debit spread and then double up the short call. And this is my call ratio spread. Not a very good call ratio spread because I'm not getting much of a credit. I really need dollar-wide strikes for this to work. So let me actually get out of the monthly cycle. Let me go to the weekly cycle where I can get dollar-wide strikes, where I can make this a little bit better as far as a better credit. Yeah, now I can get a 70-cent credit. And, this would be a normal kind of bearish trade that I would put on something where I'm bearish and it has decent IV rank. This is a call ratio spread. Now let me pick something that has low IVR. How about Dell? I haven't traded Dell lately. So Dell has an IV rank of only 6, so really low IV rank. So with really low IV rank, I'm probably not going to do a neutral trade. I need to be directional. Looking at the chart, I don't know if I really want to pick a direction in this. This was typically, since I don't have a direction, IV rank is low, I couldn't sell a strangle in this thing. I would just go find something else to trade. So that's exactly what I'm going to do. This is the process here. I'm just going to go through and find something else. General Motors right now has an IV rank of 11. That is kind of a low IV rank. Now, it did have earnings recently, and it went down on earnings. And let's imagine that I'm bullish long-term in General Motors. Well, it's a $52 stock. It's got IV of 11, which is low. A good bullish strategy for an IV rank of 11 would be a poor man's covered call. So let's do that. So let me go out in time. Let me go out to, we'll go out to the 58-day cycle, and I'm going to buy the 82 Delta call. So a really deep in the money call. I'll pay $670 to buy that call. And then in the front month, the 23-day cycle, I'll sell the 32 Delta call. The total for this trade is $587 is what I'll have to pay. And the risk profile looks like this. It kind of looks like a call debit spread, except it's calendarized, right? Because these options are in different cycles. But if I get the move up, I win. If I get the move down, I lose. A standard poor man's covered call, a great strategy when IV rank is low and you're bullish. Now, if you were bearish, you would just flip this around and do it with puts. And that is what is known as the poor man's covered put, where you buy a further out in time, deep in the money put and sell like a 30 Delta put in a shorter time frame against it. Going through the watch list, let me pick something else out of the watch list. ON Semiconductor, I trade this on a somewhat regular basis. Really good IV rank of 39. So I'm pretty long-term bullish as far as most of the semiconductors. It's had a nice run up. So, maybe because it's had a nice run up, instead of just being straight bullish and selling a put, I might do the strangle. I'll sell both sides of the trade. In this case, I'll sell the 13 Delta put, the 9 Delta call for 142 credit on a buying power reduction of only $594. That's a fantastic trade. That's something I'd put on all day, every day if I needed the trade. Now, these are just example trades, and I'm not actually going to enter any of these trades because I'm using plenty of my buying power right now. This was just an example of me going through and showing you how, just my thought process and most options traders' processes, as far as once you know a lot of these strategies and you know when they work and how they work under certain market conditions, it really becomes rather quick how you decide immediately what you're going to play and why. So there you have it, a little bit about how to choose your option strategy and for which situation. Now, if you want to learn more about options trading, and especially my favorite option strategy, which is the wheel option strategy, check out my book, The Super Wheel Option Strategy. This book is available on Amazon. You'll find a link to it in the description below. Peace, guys.